Hello friends, my name is Jardine Erlingwa, currently studying in IEM Trichy, batch 2017-19. As part of my Indian economy policy project, I'm going to discuss the various dimensions behind the balance of payment crisis which led to 1991 economic crisis in India. Breakup of the Soviet bloc. Rupee trade with the Soviet bloc was an important element of India's total trade up to the 1980s. However, the breakup of the Eastern European countries led to the termination of several rupee payment agreements in the 1991. As a consequence, the flow of the new rupee trade credits declined abruptly in the year 1990 to 91. Further, there was also a decline in our exports to the Eastern Europe. The Iraq and Kuwait War. The Gulf crisis began with the invasion of Kuwait by Iraq at the beginning of August 1990. Crude oil prices rose rapidly thereafter, from 15 US dollars per barrel in July 1990 to 35 US dollars per barrel in October 1990. Iraq and Kuwait were the major sources of India's oil imports, and the war made it necessary to buy oil from the spot markets. Short-term purchases from the spot market had to be followed up by new long-term contracts at higher prices. Slow growth of important trading partners. The deterioration of the current account was also induced by slow growth in economies of important trading partners. Export markets were weak in the period leading up to India's crisis, as the world growth declined steadily from 4.5% in 1988 to 2.25% in 1991. The decline was even greater for the United States, India's single largest export destination. In the United States, growth fell from 3.9% in 1988 to 0.8% in 1990 and to minus 1% in 1991. Political uncertainty and instability. The period from November 1989 to May 1991 was marked with political uncertainty and instability in India. In fact, within a span of 1.5 years, there were three coalition governments and three prime ministers. This led to delay in tackling the ongoing balance of payment crisis and also led to a loss of investors' confidence. Fiscal discipline. Throughout the 80s, all the important indicators of fiscal imbalances were on the rise. There were the conventional budgetary deficit, the revenue deficit, the monetized deficit, and the gross fiscal deficit. Moreover, the concept of fiscal deficit is a more complete measure of macroeconomic imbalance as it reflects the indebtedness of the government. The gross fiscal deficit of the central government has been more than 8% of GDP since 1985-86, as compared with 6% in beginning of 1980s and 4% in the mid 1970s. Increase in non-oil imports. The trends in imports and exports show that imports rose much higher than exports during the 80s. Imports increased by 2.3% of GDP, while exports increased by only 0.3% of GDP. As a consequence, trade deficit increased from an average 1.2% of GDP in the 70s to 3.2% of GDP in the 80s. Rise in external debt. In the second half of the 1980s, the current account deficit was showing a rising trend and was becoming unsustainable. An important issue was the way in which this deficit was being financed. The period of 80s was marked by a reduction in flows of concessional assistance to India, principally from the World Bank Group. There was a change in the composition of debt as it shifted from the official to the private sources like external commercial borrowings and NRI deposits. These private sources were costlier.